have a project, we assume that the project lasts 10 periods and the cost of capital, denoted by R, is time varying. We have after-tax operating income as an input and the sequence of book value capital as another input. We now compute the average rate of return, the project's rate of return. First of all, let us compute the discount factors. 1, then 1 minus 1 plus the first cost of capital. Then we paste. We copy and paste. The total project return is the discounted sum of the after-tax operating incomes. We use the sum product function. After-tax operating income in the first array and the second array the discount factors from 1 to 10. Okay, we get the total project return, the discounted sum of the after-tax operating incomes. Total invested capital, again sum product, array 1, the book value from 0 to 10, which multiplies the discount factor, the corresponding discount factor from 0 to 10, and we have the total invested capital. So the project consists of investing $1,948.47, and the profit, the total profit, is $805.32. So dividing the total project income by the total invested capital, we get 41.3%. This is an instantaneous return on investment. If you want an annual return on investment, we just have to multiply this figure by 1 plus the first cost of capital, as we have shown in the previous video. Now, let's compute the minimum attractive rate of return, the overall cost of capital. First, we have to calculate the benchmark returns, the benchmark profits. We use the cost of capital and multiply the cost of capital by the capital invested at the beginning of the period, which is 600 in the first period. This is the alternative profit that investors would earn if they invested 600 at 15%. So they renounce to $90 if they invest in the project. The project they will earn 375 in the first period, but renounce to $90. We copy and paste, and we get the alternative profits, the market returns. The total benchmark return is then given by the discounted sum of such benchmark profits. The first array is benchmark returns, row 16. Array 2 is the sequence of discount factors, row 10. And we get the total alternative profit, which is 179.13. The total invested capital, well, we have already calculated it. Dollars. Then we have the minimum attractive rate of return by dividing the total market return and the total capital invested. This is a percentage, 9.19%. So the investors who undertake this project earn 41.3% instantaneous return, but renounce to 9.19%. If they invested in the market, they could invest the same amount of capital and earn 9.19% return. In annual terms, we have the average cost of capital, and we can get it by multiplying 9.19% by 1 plus the cost of capital in the first period plus 15%, and we get 10.57%. This is an annual minimum attractive rate of return. In this way, we can also compute the economic efficiency, the financial efficiency of this project, which is the difference between the rate of return, the project's rate of return, and the minimum attractive rate of return. We can compute it from the instantaneous rates, and we get 32.1. This is instantaneous. Or in annual term, a discrete economic efficiency, by subtracting 47.5% minus 10.57%, and we get 37%. So essentially, investors invest $1,948.47 overall at an above normal rate of 37% annually. The net present value can be found by multiplying the total invested capital by the economic efficiency, the instantaneous economic efficiency. Or we can use the annual economic efficiency, total invested capital, times the annual efficiency discounted by one period. So 1 plus 15%, and we get the same result. Here it is. And we obviously could obtain the same result from the cash flows. If we compute the cash flow, at each date we have income minus the change in book value, and we get the cash flows. These are the cash flow. cash flows. The first is minus 600, and from this sequence we get the NPV as discounted sum of cash flows, and we get the same number that we have obtained, 626.19. Let's see. Sum product function, array1 is the sequence of cash flows. Array2 is the sequence of discount factors from 0 to 10. Okay, and here it is, we obtain the same number, which confirms we are correct.